Welcome to another edition of What the F Just Happened. We're recording this on July 20th. Dave Kranzler and myself are going to talk a bit about what has been going on in gold and tying that into the economy. Welcome back, Dave. There's a lot of action in the markets. Big moves today and throughout the week when Trump and our chairman of the Fed are out on a news cycle. What's your take on what's going on?
Well, it's good to be back. Definitely a lot going on this week. However, I thought I would just sort of lead off by telling you interest rates are going higher.
We're going to be forced to see higher interest rates. Our deficits are exploding, and we're going to get well over $1 trillion, and there isn't much that the powers that be can stop that from happening.
Well, it's funny because I think it was Mnuchin was out either today or yesterday saying that the spending deficit for next year was going to be over $1 trillion. Well, I would have to make the argument that the spending deficit, based on the deficit spending for the last 6 months, is going to be well over $1 trillion this year. The reason I know this is if you pull up the federal government current tax receipts on the Fed economic database at the St. Louis Fed, one way you can run the numbers is the quarter-to-quarter change in billions of dollars. And each quarter it shows, at the end of each quarter, it shows the annual run rate of federal tax receipts. And we just had the fourth largest plunge in tax receipts for the current quarter is the end of Q1 2018. And it was a $140 billion plunge in tax receipts. Now, obviously, that's related to the Trump tax cuts. Well, the three previous times we had larger plunges was the first one was at the beginning of the new millennium. At the end of Q3 2001 was a big plunge, was larger than the current one, and that was obviously related to the popping of the tech bubble, and essentially economic activity stopped after 9/11, so that would have affected the revenues. But I think the heavier influence on that was the popping of the tech bubble. And then there was also a larger plunge in the first quarter of 2002, and I don't really know how to attribute that. I mean, it was probably fallout from the tech bubble because the stock market kept going down, and I'm sure there was a loss of tax revenue from a lack of capital gains taxes. And then the biggest plunge on record was in the first quarter of 2009, and that's kind of self-explanatory. So my point here is that the rate of federal spending increases every day. And with tax rates, with the tax revenues plunging, and it's probably going to continue to plunge, I think we're going to be, by the end of the fiscal year, which is the end of September this year, I think we're going to be well over $1 trillion spending deficit run rate. And that's going to have to drive interest rates up because the only way to finance that is to sell more debt. And it looks like, with Trump's economic agenda in place, that combined with the fact that the economy hit a wall and is starting to contract, despite the propaganda to the contrary, revenues are going to continue going a lot lower than the CBO forecast, and spending is going to go a lot higher than the CBO forecast. And they're going to have to sell a lot more bonds to cover the deficit. Who's going to buy that? We know Russia's not buying treasury bonds anymore. And Japan certainly has slowed down their rate of accumulation. And obviously China's holding a willingness to buy treasuries. They're holding that over our head. I mean, they basically have an economic power edge over us, not because of the relative exchange rate of the currencies or because of the tariffs, but because they're essentially the United States banker right now.
The changes in the tax rates also are a really good indicator as to where our economy is. And that bottoming out recession that we saw in 2002, combined with, the stock market having just cratered. I mean, even companies like Microsoft went down 60% in that tech crash. The entire NASDAQ was down upwards of 65, 70%. And that lacked capital gains by the time we arrived at 2002. The government's ability to have tax coffers padded with capital gain sales was pretty much gone because the bubble had totally deflated. And the same kind of thing happened, 2009 onward. And what we're seeing now has a little bit of noise because Trump's tax cuts definitely lower tax revenues initially, but those tax cuts were launched a while ago. And we tend to see about a 12-month lag, give or take, for the stimulative effect of taxes cuts to filter in, which generally speaking can result to even higher tax revenues over time as the economy grows, and something's not working according to plan. So we have our economy showing signs that we can even see with tax revenues that suggest that there's just, we've talked ad nauseum about how government statistics when it comes to employment, inflation, and other key measures are so managed that the real conditions of the economy is masked by the investor, pool that's out there flinging money around, as well as the hedge funds and algorithm chasers and the momentum players that are in our markets pushing everything higher to the tune of where we have three stocks that represent the lion's share of the movement in the S&P 500 and the NASDAQ, as we discussed in our last show.
That's right. And I just kind of wanted to put a magnifying glass on this idea of the economy not doing what the propagandists in Wall Street and the government in DC is telling us that it's doing. In other words, it's not as robust as they're trying to lead us to believe that it is. And my indicator there is the comments that Trump made yesterday about the Fed continuing to raise interest rates. Now, to call what they're doing at the Fed raising interest rates is an insult to the word raise, because I prefer to call them, they're sort of nudging them higher very slowly. But if the economy is really as robust as Trump is been telling us that it is, why would he care if the Fed tries to raise interest rates to head off the obviously percolating inflation? Because if an overheated economy is just as dangerous as a recessionary economy, especially with the inflation that it creates. So Trump shouldn't be afraid or be pissed off at interest rate hikes, because it's a sign that the economy is doing what he says it's doing. To me, obviously, that's the sign that it isn't.
He's always been somebody who's loved debt and using it to grow his businesses, and he's applying the same thesis to the U.S. economy, along with a desire to have a lower dollar.
Yeah, I think that's right, and I think that's essentially what's behind the so-called trade wars and the threats on tariffs. I thought it was funny that it was amusing that he was talking about how the Europeans and the Asians have been stepping on their currency and devaluing it versus the dollar, and claiming that that's given them a big edge in trade. Well, the U.S. is the possessor of the reserve currency of the world. That is a much bigger edge than having the ability to manipulate your currency. I mean, that's essentially what enabled the U.S. to become sort of the unipower of the globe for the last 30 years. So to sit there and point fingers at the Europeans and the Asians like they're the culprits and we're the victims is absurd.
Well, it looks like we're going to have a currency war amplifying in the months ahead. I mean, the Chinese government, as we noted in shows past, that they're attempting to try to boost their economy by lowering the rate of yuan versus world currencies. And Trump is pretty upset about that. He's also, even today, in the aftermath of comments he made yesterday, he was out tweeting and he said, "Tightening now hurts all that we have done. The U.S. should be allowed to recapture what was lost due to illegal currency manipulation and bad trade deals. Debt coming due, and we are raising rates? Really?" He's doing a double-barreled shot, targeting the Fed, attempting to shape how it acts politically, and then also making a really big issue about currency war and his whole trade policy.
Well, it's the age-old politician strategy of of when you're losing control of a situation, blame it on everyone else except yourself. I think maybe the most interesting connection to Trump's comments was the fact that the price of gold shot up like a Roman candle as soon as his interview hit the tape. I mean, it was right at 1 p.m. New York time. And if you look at a 1 minute chart of the price of gold, that's when gold moved up like it was shot out of a cannon. It demonstrates the amount of paper gold that's been shorted over the last few weeks. My theory has been that the hedge fund category that's officially labeled the managed money category and the commitment of traders, that the hedge funds have been stepping on the paper price of gold by shorting more contracts. And lo and behold, the COT report that was out this afternoon, which captures the trading action through the end of day Tuesday, shows that, and I believe this is the largest net short position the hedge funds have ever had on. I'd have to go back, and I have a spreadsheet that shows the weekly data going back to like April 2004, I believe it is. But I do not recall seeing their net short almost 27,000 contracts. And I don't ever recall seeing the managed money that short paper gold. So I have no doubt in my mind that some of the big drops we've seen in the last 7 to 10 trading days in the gold market during London and New York hours only is a result of the managed money trying to push the price of paper gold lower so that they can book profits on their shorts. And lo and behold, if you look at the bank side of the equation, the banks were using just about every contract that was shorted by the hedge funds in the last week to cover their own shorts. And there was a substantial reduction in the swap dealer account in the net short position. In fact, the swap dealers are almost net flat between their longs and their shorts. And there was a reduction. There was actually a slight net increase in the net short position of the producer merchant, but that also has bank trades booked into it. So, again, to me, this illustrates the idea that the trading action that we've been seeing in gold, I guess, really since mid-April is just a product of the paper gold manipulation.
This is why we stuck our neck out and made the case that we are still in a stealth bull market for precious metals. And as we move forward with the economy as stressed as it is, interest rates rising, deficits rising, that something's going to give. We have a clear overvaluation in the stock market. In June, we saw a phase shift come around June 15th, where gold fell from about 1,300 to 1,274 as the cartel tried to begin to create a lot more short selling interest amongst the hedge fund community to do their bidding. And that's a process that we've seen play out for over a year. And this wash, rinse, repeat cycle is something that we've seen go on for over a decade. I think that that's what we're seeing here. And though we missed the floor, the process of all of this turning around and the fact that gold shot up and then we're back into the 1230s as opposed to actually doing a full test of 1200 is significant. There's a lot of remaining interest in the precious metals space. The miners didn't fully break down. And when we have short selling, when we have short covering with the ferocity that we see today, that speaks to a market that is not, breaking down. The traders that went short, that were and pushed into that position because of the change of the tape being manipulated downward, are scared. They want to cover.
I'll tell you another thing, that one of my theories has been that trading action we're seeing in gold is very similar to the trading action that we saw in 2008 ahead of the de facto financial system collapse. And the reason for that is that the central banks and the banks want to defuse the alarm signal that gold sends when there's problems percolating in the system. I mean, imagine there's no way that they could maintain the narrative that the economy is robust and everything is great if the price of gold was going up $50 a week instead of being hit $50 a week. So, and that's what happened in 2008, and I think that's what's happening now. And part of the test of my theory is looking at the physical market. And my friend and colleague Jesse of Jesse's Cafe Americain emailed me earlier this week. He said physical supply is tight in Hong Kong, and as it turns out, I mean, I knew this data was available, but I don't track it. He tracks the Hong Kong, the COMEX Hong Kong vault, the gold flow in and out of it. And based on the gold flow out of the vault versus the amount of gold coming in, he's concluded that gold was tight in Hong Kong. And so I started thinking, well, if it's tight in Hong Kong, it's got to be tight in Shanghai. And if it's tight there, it's got to be tight in London. So I went and I looked up the lease rates, and I hadn't looked at the lease rates in a long time. Well, as it turns out, the lease rate curve, as it were, for gold is inverted. And it goes from slightly positive for the 1 month term out to being negative and increasingly negative from 1 month out to 12 months. And the same thing for silver. In fact, the 1 month lease term for silver is negative. And what that means is when these lease rates go negative, it means the central banks are trying to force physical gold and silver into the system, because it means a negative lease rate means the central bank's actually paying a bullion bank to borrow gold or to lease gold.
Right.
And the only reason they do that would be, one, if there's delivery pressures and there's not enough physical around to make required deliveries, or if they want to manipulate the market or, drop a bunch of physical on the market. Well, I'm not sure that the central banks have enough physical gold left in their vaults that they can actually pull out and drop on the LBMA in order to smash the price. And we saw that in 2008. We saw it in, I think it was 2013 or 2012 when there was a day in April when we had about a $200 price drop in gold or close to it. And that was actually physical gold that was being dropped on the LBMA in several hundred tons of it.
And then about midnight New York time.
Yeah, exactly. So at any rate, the lease rates are showing tightness. The flow in and out of the COMEX Hong Kong gold vault is showing tightness. And I exchanged some emails with James Turk to ask him if my sniffer seemed to be accurate. And he said, yeah, he goes, I agree with you. And he said, also, there's backwardation in London in just the forward trading. So, again, this is very similar to 2008 where there was physical bullion shortages developing because they had manipulated the price so low that the amount of gold available to, it stimulated demand for physical gold from the traditional buyers, and there wasn't enough physical gold around to deliver into them. So, again, all of this ties into my view that they're taking down the price of gold as a way to try and disguise a problem that's coming, that's going to hit the system that they know is unavoidable. I'm looking for something pretty big to hit the system sometime in the next 6 to 12 months.
And that's going to come delivered on the back of rising interest rates and an economy going down, and we need to finance the growing deficit.
That's right. And on top of all that, the housing market snowball is starting to head downhill, and I think it's going to at some point accumulate into an avalanche, but we can save that for the next show. And
we have excess debt loads in the consumer, and then the everything bubble includes excessive debt among vulnerable segments of our population, like students in the student loan bubble. As interest rates rise, it's going to pressurize the entire economy. That's right. And I guess to circle back to gold, at some point, the Fed's going to have to revert back to taking interest rates back down and printing money again. That's when gold will soar. Again, and like they always break the system before they try to fix it. I mean, that's the Fed has never done a shift in policy orientation in 40 years without breaking the system first. And then they try to fix their problem. Not one single time have they been able to pull off a transition in their academic hubris without blowing something up first. Well, that's all I got for this week, Eric.
How about you?
Lick my wounds and get some capital and buy a little more gold.
Yeah, I've been thinking about buying some more gold this week myself.
One can never really nail exactly where we are bottoming, but the more important effort is to try to understand what the big picture is telling us, where we're going to be 6 months forward. I still adhere to the thesis that we are in a stealth bull market, and then the kind of economic conditions we're going to experience in the next 12 months as they unfold, combined with the everything bubble as it exists, combined with the trade war and currency war that we're seeing, and how there's just way too much debt, is all going to coalesce into a kind of financial market shift that comes out, with regularity. Trees don't grow to the sky. Markets don't go up forever. We have huge bubbles going on. Valuations in the standard equity market that just are not justified, and all this is going to reverse. So the precious metals as insurance and alternative asset exposure is now more than ever, cheaper than ever, as everyone hates the sector, and all the more important to have. So thanks for listening. This has been another edition of What the F Just Happened. We have Dave Krenzler and myself, and if you're interested in checking out Dave's work, particularly as we get primed and ready to see a lot of short positions in housing sector and stocks that Dave follows, check out his work at investmentresearchdynamics.com. You can follow what I post on Facebook at facebook.com/Eric Dubin. This show is brought to you in part by Wall Street for Main Street. The YouTube channel is accessible by clicking on the Wall Street for Main Street link on this audio player that you're looking at. And Jason Brock and his team post a lot of great stuff, really high quality interviews. Thanks again.